This is Driving Solutions, exclusively on CBTNews.com.
Hey everyone, Jim Fitzpatrick. Thanks so much for joining us this morning. On today's show, we have Erin Kerrigan, the founder and managing director of Kerrigan Advisors. You've seen her here before on CBT News with an update on the buy-sell market as we stand here today. So Erin, thank you so much for joining us on today's show.
Well, thank you, Jim, as always, for having me. It's been a very active market. Surprising.
Yeah, that it has been. That's for sure. I've been reading, here CBT News and automotive news, all the press releases and the articles about the transactions that you guys have been making. So congratulations on all of that. But how is the buy-sell market shaping up in 2024?
Well, the market really has defied expectations. There have been 204 buy-sell transactions through the first half.
Wow.
And that represents a record 381 franchises in the first half. That's more than we've ever seen in a first half. So that really surprises us all, especially given interest rates remain high.
Yeah.
There's certainly some economic concerns out there. The stock market's quite volatile, and yet we continue to see the drumbeat of consolidation. Right now, we're tracking to potentially over 760 franchises sold this year if this level of activity continues.
Wow. Another record year?
That would be another record year if we continue at this pace.
Wow. Just incredible, really is. So what is driving the continuation of this strong activity that we see?
Well, it's really two things. First, we remain in a environment where the largest consolidators are very well funded. Their balance sheets are very strong. They continue to see profits and cash flow at abnormally high levels relative to pre-pandemic. So there's just a lot of capital still out there, even in this high interest rate environment. Perhaps the best example of that is the Hudson Automotive Group went out and raised a bond to buy dealerships. So that's an indicator that the largest consolidators, both public and private, are still well funded and looking to grow and increase scale.
Yeah.
Now, that is also being met, and one of the reasons we are seeing more activity in our view is that there are more sellers coming to market. I do think the CDK outage, at least from our perspective, has caused more dealers to fast forward some of their thinking.
Oh, wow.
It's not that the CDK outage was catastrophic to their operations.
Sure.
It's more what it represented, which is our industry is becoming so data driven, much less reliant on human capital.
Yeah.
And so the business is changing in a pretty dramatic way. I think probably the next 50 years will be more dramatic than we've ever seen in terms of the way cars are sold. And some dealers are just saying, look, this is not a re-engineering that I'm looking to go through, especially since I do feel I need a bigger balance sheet, a bigger organization to make the investments in technology, to hire a chief technology officer who's going to help me utilize all this technology I keep being told I need to purchase. And yet I'm not really finding I'm getting a lift because I probably need a different sort of structure organizationally to get the full benefit of technology.
Sure. So, and with the average age of today's new car dealer being almost 70 years old based on NADA, they might just be at a point where they don't have the stomach for it. They're just, to your point, just like, look, this is not my father's business, so to speak. And it's not the business that I grew up in, perhaps. And I'll leave it to another generation to take over from me, especially if if they don't have that generation within their household, or maybe the kids don't want to get into the car business, then we do see a lot of turnover due to the fact that you've got COVID to deal with and you've got all these different elements out there that, are just kind of just an annoyance at this point in time, right?
Well, and it's not. Look, car dealers are always defy the odds and do an incredible job of adjusting.
Yeah.
There's the internet or COVID or.
Sure.
I just think what we are hearing from the clients that are hiring us to sell their businesses, most of them are just saying, look, there's something changing here in the marketplace. I can see my larger competitors are using data to determine what inventory to stock in,
Yeah.
how to price used cars. And that data driven model oftentimes is a very different model than one that is reliant on the human capital of just the working hard and selling cars.
That's right.
And I do find more of our clients are saying we're finding ourselves not having the right inventory, or not having the right data on our customers, or not having the right systems in place. And those systems oftentimes require just larger scale to implement.
Yeah.
It's harder when you have one or two dealerships
Of
to
course,
really revolutionize the way you think about your operations,
Yeah, very good point.
especially on the sales side. So
Sure.
that is what we're seeing.
Sure. Where do buyers see earnings headed?
Well, I think this is good for everyone. Everyone is starting to sense that we are normalizing. So we're seeing buyers really look at current earnings, meaning the trailing 12 months, second half of 23, first half of 24, as the new normal. Now, that's not for all brands. We have some brands like Chrysler and Stellantis that are really struggling. One hopes their current earnings are not their new normal, because they're not awesome. And Nissan likewise are really struggling.
Right.
But largely for the industry, most are starting to say, okay, I think we are at a stabilization standpoint, which, by the way, is about double pre-pandemic earnings. So it's very attractive. Now, that's not inflation adjusted, so it's not quite double if you adjust for inflation, but nonetheless very strong. And we are seeing grosses on new also starting to stabilize.
For sure.
We hear the public say, look, we think we're going to normalize at $3,000 front end gross profit and on new vehicles. That, by the way, includes, of course, the funds they receive from the OEMs.
Right.
So the publics look at it differently than most private dealers. But at $3,000, that's on a inflation adjusted basis. If that's where they stabilize, that's about $500 higher than the pre-pandemic average. Again, inflation adjusted. So that's about that seems pretty attractive from where we were, and it looks like that's where we might stabilize, assuming we don't have too much overproduction. But again, we are seeing a divergence between franchises too. So this is average. This is that we do have a bell curve. So there's some outliers.
Of course, sure. So having said that, how is the market valuing blue sky?
Well, right. So having said that, what we're seeing is a return to a focus on current earnings when valuing. So pre-pandemic, we as a firm always said, look, our blue sky multiples that we publish should be applied to current earnings. And then the multiples are adjusted up and down depending on that specific dealership. If a dealership was underperforming, often the multiple was higher than what we published. If it was overperforming, often the multiple was lower. If you had a new facility, it'd be adjusted down. If it had a perfect facility and great rent factor, it might be adjusted up. So we're really returning in many regards to the way we did this before the pandemic. And that's pretty refreshing, because all of the, guesswork associated with where earnings are going to normalize is going away. And so we're pretty happy. I think everyone can have much more clarity. We did produce for the first time last quarter the Kerrigan Blue Sky Index, and we thought this would be very helpful for the industry to start saying, okay, where are blue sky values indexed to 2019, to pre-pandemic. And so if the index started at 100 in 2019, we see the index right now at 174. So effectively 74% higher pre-pandemic levels. Now, of course, that's not inflation adjusted. So I have to always say that, because we've had with inflation. And that's about 20% lower from the all-time highs.
So are the publics very active right now? So
the publics were not active at all in the U.S. in the second quarter. The only acquisition that was reported was Lithia's acquisition of Kerrigan Advisors' client in Tennessee, Sunrise Automotive Group, which closed in the second quarter. That was the only one that we saw identified. In the first half, the publics have spent about $1.2 billion on U.S. acquisitions. Last year, they spent in the first half $1 billion, so they're up 20% for the first half. But most of those acquisitions occurred in the first quarter, not the second. So there was a slowdown in the second quarter. And actually, if you look at the first half, the publics only represented about 6% of the buy-sell market. Interestingly, 38% of the buy-sell market was represented by the largest private consolidators. So they have really leaned in with where the publics are not doing as many acquisitions. The private large consolidators like the Hudson Automotive Group I mentioned that's tapping into the bond market. They very much are leaning in, and they increased their share of the market by 20 percentage points. So a huge increase in their share of the market.
Now we've done, as you know, so many stories here on the EV situation, as it stands today, and all that goes along with it, and what OEMs were expecting, and now they're recoiling their projections, and dealers are frustrated, and those are the vehicles that are aging, and they can't get rid of them, and so it's been a real problem out there. So talk to me about that. What's the EV situation, or I should say maybe the impact that it's having in blue sky today, in the blue sky values?
There is no question that the way in which OEMs implement their EV strategy is going to have monumental impacts on blue sky values. And we've reported on this in our blue sky report over the last 4 or 5 quarters, just saying, look, this is a big deal. It is not surprising that we see Toyota as the number one OEM from a dealer standpoint, as their plans for EV production are more aligned with where the market is relative to others. A Mercedes, who has a plan, at least I think it's changing as quickly as they can, but in their plan for their 25 to 28 model year vehicle production is 54% EVs. Well, in the first quarter, we only had 7% sales of EVs in the market. So it's a big delta between what they plan to produce and what the market is actually purchasing. So we do see we are starting to see an impact of how OEMs are rolling out their EV strategy is starting to have implications for blue sky values. For instance, Mercedes, we just downgraded from a steady to a negative outlook on their blue sky multiple. Part of it's the EVs, and then part of it's also another trend we're seeing related to OEMs exercising their right of first refusal and really trying to play a much heavier hand in how their network is structured, their dealer network.
Toyota seems to have gotten it right in this EV situation for sure. They were kind of, talked about a lot negatively, a couple of years back, where it was Toyota's not catching up, and they're not keeping up, I should say, with the EVs, and they said, hey, we're pumping the brakes, not so fast on this. We just don't believe the market's there, and they called it right. Interesting.
That's exactly right. And they're very much focused on hybrid. And that is all know those are the plug-in hybrids, and hybrid vehicles are in the highest demand, and they are very well positioned in that marketplace. So Toyota, again, seems to always do everything right. And not surprisingly, that they are the franchises that are in the highest demand in our experience.
That was my next question. What a segue, right? That was the next question. Which franchises are in greatest demand? And then which ones are you seeing less interest in?
Well, we're definitely seeing buyers flock to quality now. So whereas during the pandemic, the rising tide lifted all boats, and all franchises anywhere were pretty darn attractive and trading at record values because there was so much money seeking opportunity, and there were very few opportunities for dealerships because everyone was making so much money. No one
Right.
was selling.
Right.
Now there you have franchises that aren't making money. You have franchises so you have more dealers considering a sale because they're not making as much money and they're thinking, okay, maybe I just need to get out. And you have buyers now with more options. So they are very much focusing on the franchises that are doing the best, and those are the typical top franchises. And also they're focusing on the top markets, so the high growth markets, the southeastern US, Arizona, Nevada, Texas as well. Very high demand for franchises in those markets. What we're seeing in terms of the top franchises is we are seeing or those that are increasing in demand are the top luxury. Mm-hmm. Luxury is outperformed in sales in the industry in the first half. So we continue to see folks flock to those rare assets of the Porsche, for instance, Lexus, and BMW has done an incredible job with their EV rollout. Mercedes, as I said, Mercedes is still in demand, but some of the things that Mercedes has been doing in terms of really playing a heavy hand in their buy sells. It is caused some buyers to back away, and also they haven't done a great job with their EV rollout. So that has been a negative on Mercedes. We also have seen a negative on Hyundai recently. We reduced our outlook on Hyundai after so many years of doing such an incredible job. We reduced it from steady to negative. Now we haven't reduced the multiple, but we are starting to see, because Hyundai likewise is taking such a heavy hand in the way they're managing their network and effectively saying, look, if you want to sell your dealership, we want you to come to us first and we'll tell you who you should sell it to. And that manipulates the buy sell market and effectively reduces the number of players who will enter and want to buy the franchise because they don't think they're going to get to be able to buy it.
Are you putting Genesis in with that, or is Genesis a different story?
We do not have a blue sky multiple on Genesis. It's still pretty nascent as it relates to the number of buy sells. We don't have buyers calling us seeking the franchise, so we don't have a multiple. But I will also say CJDR and Nissan also, we reduced their multiples. We would say that they have the weakest buyer demand and the highest buyer avoidance right now, especially given the day supply you're seeing in the case of Stellantis. It's just, I'm sure you've heard and reported that dealers are really struggling with the pricing of those vehicles. So that's also what we have seen in the marketplace. Now, we do have some positives. We increased the outlook for Honda and JLR to positive. We are seeing huge demand for Honda, and Honda's doing great. Their day supply has shrunk. Their sales are growing. So much more demand for Honda, and also JLR, specifically LR. Jaguar still, is a very small franchise, but Land Rover, great day supply. And buyers really are still seeking that franchise as just the halo effect of that. Range Rover is the first mover in the luxury SUV market. They still have that position. And lastly, we actually improved Ford's multiple outlook from negative to steady with their reversal on their EV requirements for their dealers. There is a lot more positivity we're seeing in Ford than we have in the last 12 months. So that was another positive.
Awesome. So if you're a Nissan dealer or a Stellantis dealer, move your dealership to South Florida and there's buyers waiting. Is that what I'm hearing?
that is not a bad idea if feasible. Yes.
That's right. That's right. And that will improve, the saleability of that franchise right now. But it's funny. We've had this discussion over the last 12 years. And they run hot and cold. They always have. I mean, you've had your, kind of your foundational brands out there that always do well, your Porsches and Lexus and Toyota and what have you. But a lot of the other brands will be hot one year and then cooled off and then hot, and it's crazy. It really is.
No, I think that's that's right. I mean, Stellantis in particular, there are periods where they make so much money. I mean, the dealers are making just so much money, and then all of a sudden they're not making. That you have a huge percentage of the dealer body that's losing money, and it's extremely volatile. And I always like to say that a blue sky multiple, or a multiple for any business, a PE multiple in the stock market, is a reflection of the expectations of future earnings. And when you have really volatile earnings, when sometimes it's high and sometimes it's low, that's a higher risk franchise, and it's going to have lower expectations. So it's going to have a lower multiple. By contrast, the Toyotas and Lexuses of the world, they're just, what you're getting. They're steady earnings businesses. And as a result, the risks are lower and the multiples high.
And you can always get out of that dealership if you want to or need to at any given time. There's a line of people that are raising their hand going, sell it to me, sell it to me. Not so much the case with the troubled franchises, for sure.
That's right. Now, also, if you're in a great market, like you said, Florida. So Florida and Texas, the growth dynamics of those locations result in an environment where the pie's always growing. So even if you have a weaker franchise, you have the wind at your back with population growth that's causing sales to grow, and it counterbalances any specific challenges a franchise might have.
Yeah, that's right. It's crazy. Any other trends that are worth noting that you see out there?
Well, I would just say that we are seeing some impacts of the contraction in lending. So if you look at the commercial industrial business loans as a percentage of GDP, it has been contracting.
Okay.
And for the first time, really since the great financial crisis, we've seen a situation where on a weaker franchise, the lender is unwilling to finance an acquisition. We're talking even about floor plan, because they don't want to be stuck with vehicles and inventory of a failing franchise. And we haven't seen that in a very, very long time. And to some degree, it's not surprising when you look at the average dealership's the change in the floor plan expense from when it was an income to now where it's an expense is over $400,000 on an annual basis.
Wow.
So that's a big chunk of the earnings. Now that's for the average. So for those that have over 100 days supply of inventory, and that carrying cost is starting to really impinge upon a dealer's ability to earn a profit. So that's a certainly a newer trend and something we're keeping an eye on. It does bode well for those franchises with really strong captives that support their dealer network. And I always like to say that credit is a core competency of this industry. So when you have an OEM that has a very well-funded captive with a really great credit rating, that means their cost of capital is low. That means the dealer, the franchise, benefits from that. And there is a correlation between the credit ratings of the OEMs and the value of the franchises they represent.
Interesting. Very interesting. Very good. Very good. Erin Kerrigan, founder and managing director of Kerrigan Advisors. I know that you know that name if you've been in the industry for any longer than a week. So these guys are tops in what they do. So thank you so much, Erin. Really appreciate you stopping by CBT News. We always get so many great comments whenever you're on. So thanks so much.
Thank you so much, Jim. You have a great fall.
You too.
Thanks for watching Driving Solutions, exclusively on CBTnews.com.